are in the main correct in assuming that if property is owned jointly, the default rather, is that if the property is owned jointly, then the income and the expenses would be split jointly. The revenue have a helpful form called a Form 17, I think it still exists, that effectively says that if you change the underlying beneficial ownership of the property, which you can also do with the help of your expert legal advice, then you don't have to change the title deeds of the property. And you could actually say, well, actually the property is held 95% in one partner's hands and 5% in the other, but the title deeds still say 50-50. And in which case, so if one's a high earner and one's not a high earner, you can actually split it. You can't do that with hindsight. You must do that, say, you know, if you did it today, it would apply from today onwards. There's no element of retrospection in this, but you are able to effectively move around the entitlements of the property. And we've got other situations where, for example, we've got properties held in slightly different sort of scenarios, but where there's a sort of prior charge of profit for a lower earning spouse to a relationship or lower earning partner in the relationship, which is reflective of the fact that they're actually sort of doing a lot more of the rent collection work and other activities. So there's effectively a notional prior charge as well. But once again, that needs to be reflective in the underlying ownership of the property. And the revenue sort of tightened up in this kind of underlying asset rule, I don't know, about 10 years ago, I think, something like that.